Welcome to the video. Today we'll explore the $17,000 dilemma. Whether to cash out pre-tax retirement savings to cover immediate needs, such as urgent home repairs, when you are age 59 and a half or older. We will focus on the real risk income taxes, not the early withdrawal penalty, and show a practical technique to manage taxes by splitting the withdrawal across 2 calendar years. We will also cover rollover options, the trade-off with long-term growth, and a quick note about Social Security while working. To keep things actionable, we'll share a step-by-step plan, diagrams, and a couple of quick quizzes. Now, let's outline what's ahead. Here is the agenda for this video. First, we define who this guidance applies to. Next, we focus on the real risk of withdrawing pre-tax funds, the income tax impact rather than penalties. Then, we explain the 2-year split strategy, including a December and January distribution approach. After that, we compare cash-outs to rollovers and Roth conversions, followed by an execution checklist. We will also touch on claiming Social Security while working, and finish with common pitfalls and pro tips, along with short quizzes. With the roadmap set, let's clarify the audience. This section is for individuals age 59 and a half or older who have pre-tax retirement accounts, such as a profit-sharing plan from a prior job, and are considering withdrawing around $17,000 to meet short-term needs. If you are transitioning careers or leaving a part-time role, you may face decisions about consolidating, rolling over, or cashing out an old account. Now that we know who this applies to, let's address the real risk. Before we begin, please note that this content is educational and not tax, legal, or personalized financial advice. Always consult a qualified professional for your specific situation. Plan rules differ, state taxes vary, and regulations change over time. With that foundation, let's focus on the central issue. For individuals who are 59 and a half or older, the 10% early withdrawal penalty no longer applies. However, taking money from a pre-tax retirement account still increases your taxable income in the year of withdrawal. A lump sum can push a portion of your income into a higher marginal tax bracket, which increases the tax on the top slice of your income. This rise in income may also increase the taxable portion of Social Security benefits for some people, and can raise Medicare premiums through IRMAA surcharges, as well as impact various deductions and credits. If the expense is not urgent, rolling the funds into an IRA or another employer plan can keep the tax deferral intact. With that in mind, let's visualize the decision process. This flowchart starts with whether you need $17,000 now. If you do not, the recommended path is to roll over the funds into an IRA or a current 401k to preserve tax-deferred growth. If you do need the funds, ask whether the expense is truly critical, such as urgent health, safety, or necessary home repairs. If the need is not critical, a rollover remains preferable, with consideration for smaller, planned withdrawals or strategic Roth conversions. If the expense is critical, evaluate whether taking the full amount in a single year would push you into a higher tax bracket. If yes, splitting the withdrawal between December and January spreads the taxable income across 2 different tax years, potentially reducing the impact on your marginal rate. If not, taking the full amount in 1 year may be acceptable, provided you manage withholding and understand the implications. Keep in mind plan-specific rules, possible mandatory withholding, state taxes, Medicare premium surcharges, and Social Security taxation effects. Next, let's focus on how the 2-year split works. The 2-year split strategy involves taking approximately half the distribution in December and the remainder in January, allowing the income to be recognized across 2 tax years. The goal is to reduce how much of the distribution is taxed at your highest marginal rate in a single year. For instance, you might take $8,500 in December and another $8,500 in January to total $17,000, but with the income spread across 2 returns. You still need to manage withholding elections, consider state taxes, watch for any planned distribution fees, and complete the proper paperwork on time. To help you visualize timing, let's look at a timeline. This timeline shows action steps across 2 years. In early December, confirm your plan's processing deadlines and any mailing or banking delays. In mid-December, request approximately $8,500 and verify that the deposit and withholdings are processed by late December. In early January, request the remaining $8,500. Confirm the tax withholding and deposit mid-January, and then ensure you receive and track the separate 1099-R forms for each year when tax season arrives. Now that you've seen the timing, let's turn it into a concrete checklist. Follow this checklist to execute the split. First, verify that you are age 59.5 or older so that no early withdrawal penalty applies. Second, ask your plan administrator about distribution deadlines, any fees, and mandatory withholding rules. Many qualified plans must withhold 20% for federal taxes on non-rollover lump sums. Third, select your December and January split amounts in consultation with your tax preparer. Fourth, submit the December request early enough to ensure that it is processed within the same calendar year. Fifth, submit the January request once the calendar has turned to the new year. Sixth, track the separate 1099-R forms and keep organized records for both tax returns. Seventh, consider alternatives such as a direct rollover to an IRA or 401k, or potentially a partial Roth conversion if it aligns with your plan. Finally, be mindful of state taxes, Medicare premium surcharges, and how added income affects the taxation of Social Security benefits. Next, let's pause for a quick quiz to reinforce the key concept about penalties and taxes. Question: if you are age 59.5 or older, what is the primary risk of cashing out $17,000 from a pre-tax retirement account? Options: A. A 10% early withdrawal penalty will apply. B. It will increase your taxable income for the year and may push you into a higher marginal bracket. C. You cannot withdraw from pre-tax accounts after 59.5. D. Social Security benefits automatically stop if you withdraw from retirement accounts. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. At age 59.5 and older, the 10% early withdrawal penalty no longer applies, but the distribution is still taxable income and can push part of your income into a higher marginal tax bracket. Now let's walk through a simple numbers example so you can see how the split might help manage your marginal rate. Here is a conceptual example. Suppose your other income puts you near the top of your current tax bracket. If you take the full $17,000 in 1 year, the top portion could spill into the next, higher marginal bracket. By contrast, if you split it as approximately $8,500 in December and $8,500 in January, the taxable income is spread across 2 separate tax years. This can reduce how much of the distribution is taxed at the highest marginal rate in either year. We are not using specific bracket numbers here because the thresholds vary by filing status and change over time. With the concept clear, let's compare your main strategy choices side by side. This table compares 4 strategies. A 1-year cash out provides immediate funds but risks pushing income into a higher bracket and gives up future tax-deferred growth. Some plans impose mandatory withholding on non-rollover distributions. The split strategy spreads income over 2 years, which can reduce top bracket exposure, but it requires 2 requests, careful timing, and tracking 2 information returns. A direct rollover to an IRA or 401k defers taxes and avoids mandatory withholding when done as a direct trustee-to-trustee transfer, but it does not provide cash today. A partial Roth conversion intentionally creates taxable income now to potentially reduce lifetime taxes, but it is more complex and can affect adjusted income measures used for benefits and premiums. Next, let's talk briefly about Social Security while working. You may claim Social Security benefits while working, and continued earnings can increase your future benefit if the new earnings replace a lower year among the top 35 years used in the benefit calculation. If you claim before your full retirement age, the earnings test can temporarily reduce monthly payments if your wages exceed certain limits. These reductions end after you reach full retirement age. Also note that higher income can increase the portion of Social Security benefits that are taxable. Having covered Social Security considerations, let's visualize how a rollover works to preserve tax advantages. This sequence diagram shows a direct rollover process. The participant requests a direct rollover from the old plans. The old plan sends a trustee-to-trustee transfer directly to the IRA or new employer plan custodian, which avoids the 20% mandatory federal withholding that usually applies to eligible lump sum distributions not rolled over. The custodian receives the funds in a pre-tax account, preserving tax deferral. The alternate path shows a cash distribution request, where the plan sends funds to the participant, subject to income taxes and potentially mandatory withholding, typically 20% for many qualified plan distributions. Now, let's challenge your understanding with another short quiz. Question: what is the key advantage of splitting a $17,000 pre-tax withdrawal between December and January? Options: A. It avoids all taxes on the distribution. B. It ensures no withholding applies. C. It spreads the taxable income across 2 tax years, potentially keeping more of it in lower brackets. D. It guarantees a lower total tax bill regardless of income. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. Splitting the distribution across December and January spreads the taxable income across 2 tax years, which can help keep more of the income in lower tax brackets. This does not avoid taxation, nor does it guarantee a lower total tax bill in all cases, and withholding rules still apply. Next, let's reinforce the most important points. These are the key takeaways. First, once you are 59.5, the early withdrawal penalty is no longer applicable, but the distribution remains taxable. Second, taking the full amount in 1 year can push some of your income into a higher marginal bracket. Third, splitting the withdrawal between December and January can reduce that effect if timing allows. Fourth, rollovers preserve tax-deferred growth, and direct rollovers avoid mandatory withholding on eligible distributions. Fifth, be aware of state taxes, Medicare premium surcharges, and the taxation of Social Security benefits. Finally, if the need is not critical, consider preserving the account or planning smaller, tax-aware withdrawals. To help you remember, let's revisualize the decision path succinctly. This pie chart illustrates the main effects of a pre-tax withdrawal. The largest slice represents the increase to ordinary taxable income. A significant portion may be taxed at a higher marginal rate if it pushes you past a bracket threshold. Smaller but important slices show potential secondary impacts, including an increase in the taxable portion of Social Security benefits and possible Medicare premium surcharges under IRMAA. Now, let's wrap up with a concise summary. In summary, for truly critical needs, cashing out might be necessary, but plan the tax impact carefully. When timing allows, splitting the distribution across 2 different tax years can help reduce bracket spikes. For non-urgent needs, a rollover is often preferable to preserve tax-deferred growth. Work with a qualified tax professional to coordinate withholding decisions and to plan for state taxes, potential Medicare premium surcharges, and the taxation of Social Security benefits. Before we close, here is a quick comparison reminder. On the left, cashing out now provides immediate liquidity and is relatively simple to execute, but it risks pushing income into a higher tax bracket, forfeits future tax-deferred growth, and may be subject to mandatory withholding for qualified plans. On the right, preserving the account through a rollover maintains tax deferral and, when done as a direct rollover, avoids mandatory withholding. It also provides ongoing investment flexibility. However, it does not provide immediate cash and does require account setup and coordination. As we close, let's thank you for watching and invite your engagement. Thank you for watching. If you found this helpful, please like the video, share it with someone facing a similar decision, and subscribe for more practical financial guidance. Share your scenario or questions in the comments, and let us know how you would handle a $17,000 decision. See you in the next one.